Hello, good morning and welcome. You've tuned into ET Now and this is Buy Now, Sell Now with me, Varun Hiremath, and along with me, Karunya. Let's take a look at the markets this morning. 14,215. Now we're trading firmly above there. We are pretty much at the high point of the day, just around 20 points shy of there. Market breadth really looking good, 37 advances versus just 13 declines on the Nifty. Now let's start paying attention to the benchmarks to figure out where the collective action is. Banking index up 0.4%. Auto index up 0.6%. Mid-cap index up nearly 1%. Now I'm just waiting for the individual indices to come up on my screen so we can get a better picture of what's happening. The small cap index today 0.84% higher, doing very well. We are seeing FMCG taper off slightly today, a spot of red, 0.5% down for the FMCG index, but the IT index is up 0.75%. The media index shining today, 1.3% higher for that one, and metals making a strong comeback, the Nifty metal index up 0.65%. Within financials, PSUs are definitely leading the privates today. The PSU banking index is up 1.24% versus the private bank index, which is up just 0.25%. Individual winners and losers, we have a GAIL, ONGC, IOC. Fuel and energy linked stocks, three of them really rebounding. Perhaps that's got something to do with where crude is. Bharti Airtel making a firm comeback. First time we're seeing it above 525 in a long time. It's at 527, up nearly 3%. SBI also looking very good today, 288. Like we said, the PSU bank index fairly higher. On the losing side, second or third day now in a row, Bajaj Finance and Finserv cooling off post that Q3 update. Bajaj now going almost below 5,000 and Finserv 8,700, so 8,800 breached. Reliance having a weak day as well at 1940. ITC losing some gains at 208 and Hindustan Unilever down about 1%. So I'd say broadly we're trading with firm positive bias, but of course the market's now getting selective about where to buy. Back to you, Karunya.
Right. Well, markets definitely looking quite firm. Let's pull up the BNSN stock cloud to tell our viewers which are the individual names to keep on their watch list. The stocks making the news today. First up is a BEML, continues to rise. They've bagged an order for supply of high mobility vehicles from the Ministry of Defence worth 758 crores. Next up, Titan. The heavyweight has informed the exchanges about their Q3 update. The jewelry division crosses from recovery to growth phase. That is the bottom line as far as the performance of the quarter gone by concerned. Ramco System has signed a multi-million-dollar deal with global Fortune 500 major. The stock continues to look up in trade. Their Stanla Platforms, another small cap that continues to rise. They're looking to launch global scale CPaaS platform in end of this month. This GCPL, they also delivered their Q3 update, though the street doesn't seem too enthused with it. ACC has announced the commissioning of new cement production facility at their existing unit in Jharkhand. There's also Hero MotoCorp zooming in trade. LIC has increased its stake in the company from 9.16% to 9.16% from 7.14% earlier. So they've upped their stake by almost 2%. CSB Bank in focus. SBI Mutual Fund has raised the stake to over 5% in this lender. And lastly, you also have Jubilant Food, JP Morgan maintaining its overweight rating on the counter. They say that portfolio expansion and loyalty program are the new enablers in the making for this counter. So there you have it, top stocks to watch out for at this hour.
Almost time to talk technicals and fundamentals with our experts, but let's first just give our viewers the BNSN Quiz Connect question for today. You'll have another 40 minutes to answer, and if you're correct, we'll feature your name on the channel at 11:45. The question for today, which one of these capital goods companies reported the highest margins last quarter? So that's in Q2 of FY21. Your options are ABB, a BHEL, a Cummins India, and a KEC International. So do tweet to us quickly, and maybe if you're the lucky ones, you'll see your name on the screen at 11:45. Let's now switch gears. Kunal and Gaurang Shah are both with us. Good morning, gentlemen. Thanks for taking out the time. As always, great to have you here with us. Kunal, looks like the bulls are yet again in control, 14,200. And obviously, global cues were a bit supportive this morning. But what's your read? Are we just going to continue this, or will it consolidate somewhere? And in light of that, what are your calls for today?
So good morning, Varun. I think it's now become a buy on dips market. We've seen so many corrections, on the short-term time frame charts, whether it's the intraday, whether it's the intra-week correction. A couple of weeks back, we had a 600-point correction. Yesterday or day before, we had the indices opening with a gap, a gap down take. So I think all of these short-term corrections are getting bought into. So I think the classic way to define is it's now becoming a buy on dips market. And I think looking at the short-term aspect, the market internals overall, I would sense that this trend would continue. The best part about the market is not the buy on dips phenomena, but it's the strength across so many sectors and so many stocks which are coming across at every point of time. So you don't have a select high beta pocket which for one is doing pretty well. You have a mix of high beta, low beta, the defensives, IT, pharma, metal stocks, etc. They're doing so well for themselves. So the markets can bank on so many of these other individual names to try and move up higher. The only I would say uh, hindrance to the market is the underperformance of Reliance Industries, which I think is now getting a bit more prominent. The stock is now below that 1950 mark. So I think that apart, overall market trend remains to be extremely bullish until the time we are trading about 14,000 level on the spot basis. I think that the near term trend should also be on the bullish side. So in that light, I would suggest two buy calls. And the focus is more on the auto stocks today because I sense that now it could be turn of the auto stocks and large cap names in that front to try and show us signs of breakout. First one which I picked up is a man Hiremath Corp as a buy stock, looking extremely strong. It's coming back after a deep consolidation of almost 2.5 or 3 months. So would suggest the buy Hiremath Corp for a target of almost 3,400 approximately, and stop loss could be kept at 3,050 approximately. The second would be a buy in Tata Motors. Now this is a high beta stock. I've termed this as a high risk idea purely based on the fact that it's a slightly bit high beta stock as compared to its other peers. But the way the stock is showing signs of a breakout, I think it's just about exemplary. It's now in touching distance or very near to its psychological breakout of 200 mark as well. So would suggest a buy in Tata Motors. In the morning, I'd given a target of 200. I would revise the targets for a fresh trade to be taken at current levels. Targets could be kept at 205, 210, and stop loss could be taken to 190.
All right. Thanks for your trading calls then, Kunal. Gaurang, hi, and wish you a happy new year. I think this is the first time we're having you in 2021. What are the stock ideas you have for our viewers who want to invest for the long haul?
Thank you, Karunya, and first of all, wish you, Varun, and your entire team at ET Now, along with all the viewers of ET Now, a very healthy, prosperous, and a happy 2021. Well, for us, I think there are two important triggers, Karunya, in the near term. First one is the curtain raiser for the Q3 earnings, starting with I think 8th of Jan. I think you have TCS doing the curtain raiser for the third quarter earnings, and then thereafter you have the budget in Feb. So if you need to position yourself in this market from a near-term point of view, I think you should look at sectors and stocks which will possibly have the capability of moving at a higher level with these two triggers in mind. And with that in mind, we have identified two investment ideas. This could be, medium to long term. First one is FMCG Colgate. I think the stock is at 1620 or thereabouts. We have target of 1850. These are fundamental, of course. The second one is from the life insurance pack, and that is ICICI Prudential Life. I think over here again, I think after a long time, the stock has managed to move above 500 level, and it's a good momentum. And with the budget in mind, our sense is that insurance-related stocks, both non-life and life insurance, and more so life insurance-related stocks, should be in the spotlight at least from the near term. ICICI Prudential Life, on a fundamental basis, we have a target of 580. Now, this is a very conservative target currently. We're pretty sure that earnings, visibility and growth will definitely make us move the target on the higher side. But as of now, 580 is the target on ICICI.
Okay, thanks for that, Gaurang. Request both our experts to stay on. We'll resume queries in just a minute. But earlier this morning, our managing editor, Nikunj Dalmia, caught up with Jim Rogers in quite a rare interaction where they explored the risks that may be lying at the end of this equity rally. And in light of that, what his more conservative picks are for the next decade. Let's listen in.
Travel, tourism, transportation, agriculture. So those are areas where I see opportunities going forward. I know we're going to fly to New York again in the future. I know we're going to fly to London again in the future. So I am looking more at the areas that have been damaged: travel, tourism, entertainment, transportation, things like that, and agriculture, which I mentioned. So that's where I'm looking more than other areas right now. Silver and agriculture are easy to say. Maybe oil. Maybe oil. Maybe oil. Oil is a disaster. And if it's for a decade, probably energy, yes.
Welcome back. You're still watching Buy Now, Sell Now. Both Kunal and Gaurang are still with us. Time to bring on board our viewer queries. First up is a Twitter query from Roni Churayat. He has bought 3,200 shares of Burger King at a price of 191, and he wants to know whether he should continue to stay invested or exit from this particular counter. Kunal, I know there's not too much historic trend available as far as Burger King chart is concerned, but is there any advice or recommendation you'd like to give?
Well, yeah, I think very limited history for me to really comment. I think the stock range has been 150 as a support and 200 as a resistance. That's the best. I think the last 15-20 trading sessions, the stock has shown in terms of price patterns. And currently, I think it's exactly at the middle point of this range. So I think it's at 170 or 175 range, which is exactly the midpoint of this range. So difficult to categorize that how the longer term or the medium term trend could pan out. I think the best which I can say is that have a stop loss of 150 mark. That's where there were two attempts of the stock trying to break that 150 level, and both of these attempts resulted into a strong buying spree into the name. So I think if this 150 level gets breached, then there could be a possibility that the near term trend could reverse. But I think difficult to comment on the medium term to longer term aspect because of the limited stock history.
Gaurang, your view on Burger King? It's a very recent addition to the primary markets, but given the consumption trends, given the fundamentals of the company, what would be your call?
So Karunya, we had a subscribe note to the IPO, and one of the reasons that enabled our subscribe view was the pricing of the IPO. It was at 60 rupees, which was less than the cost of a burger. So here you had a proposition when you could buy the company that sells burger less than the cost of a burger. So valuation wise, it was very attractive. Secondly, the kind of oversubscription that it got. Thirdly, post listing, I think the stock was a flyer. I think it went up to 200. Correct me if I'm wrong. Now, I am assuming, looking at the quantity of the stock that this investors got, and I hope it is not a punting or a short-term bet which has gone wrong, which is why he's holding on to it. Secondly, if he's long-term investor, yes, you are absolutely right. This is one of the few additions to the QSR segment, that is quick service restaurant, led by the best stock in this sector, that is Jubilant Foodworks, followed by I think Westlife. Third one is of course Burger King. So long-term point of view, my advice would be that hold on, but next time don't do this mistake. Don't never overexpose yourself to one particular sector or stock. We remain extremely positive in terms of the earning visibility of this company, and one of they have made quite a few additions on the menu, and they have come out with some very attractive combo offers as well. If you are in for the long term, hold on to it. If you have investable amount with a high risk appetite, my advice would be that you can add to the stock, maybe somewhere not at current levels, but somewhere close to about 150, 155 would be a very comfortable zone. That will also bring down your average considerably. But two things: don't overexpose yourself. Hold on to Burger King from a long-term point of view, and if you're a high-risk investor with a little bit of more investable amount, then average closer to 150.
Okay, so both are experts fairly positive on it. Just advise some caution given that it's run up so quickly post that IPO. Let's move on. Harnish Ashar has written to us, please share your views on Borosil Renewables. Kunal, coming to you first. Of course, it was a What's the Story candidate here on ET Now. It's been a top performer this year. I think it's been up 10x or so. What little I know about the company is that they make glass for solar panels and they have some kind of monopoly here in India. Based on that chart, though, do you think you can still enter, or do you need to wait for a bit of a cool-off?
Cool-off has started to happen for the stock. I think, if I'm not wrong, the stock seems to be at 279. The recent high for the stock was approximately at 323, 324 approximately. So it's going through that 15% of correction. Maybe you might have one more round of cool off which could happen, which could take the stock back towards that 250, 240 mark. That could be where some near-term supports arise for the stock. But there's this one catch for stocks like Borosil New, etc., because many of these stocks, they tend to flourish extremely well in a market which is very buoyant. The mid cap and the small cap end of the markets, they tend to show some very strong recovery in the best phases of the market. But whenever there is a cool off or consolidation, these are the kind of names which tend to test a lot of patience for long-term investors. So I would suggest that if you're looking to enter, I would suggest 250 could be a good rate where you can start entering the stock. But again, the catch over here is that it's a high beta stock, and again it's a mid cap oriented theme which tends to do pretty well in only strong bouts of market trends.
Okay, thanks for that, Kunal. Of course, some interesting insights on the chart. But Gaurang, coming to you, what's happening at Borosil Renewables? Why has this run-up been so tremendous, and is it likely to continue?
So Varun, if I'm not mistaken, it was primarily because of the policy changes from the government side that you saw the run-up in this particular counter. Secondly, historically speaking, I think this counter is extremely low on volumes. Correct me if I'm wrong. Thirdly, there is no fundamental triggers as of now post the run-up that we've seen that will excite us on this particular counter. What I'm trying to say, Varun, is that we don't have a fundamental coverage. And I think 2 points. One is the run-up, second one is the liquidity, and third is the earnings clarity. When these three things are missing, especially in a counter which has run up because of certain news flows and some policy changes, it is only prudent to be a little bit careful and cautious. I would advise that if you do want to invest from a long-term point of view, FMCG Dabur would be a suitable candidate to invest in.
the recommendation coming in on Borosil. Moving on to our third query, which also came to us via Twitter. Shyam Karani writes to us, he wants our experts' advice on a good innerwear company at the current levels. He wants to know between Lux Industries and Dollar Industries because Page, according to him, is something that is too expensive at this juncture. So these are the two companies essentially that he wants to bet on. And why not? I mean, given the way the traction has been in innerwear and leisurewear market, especially owing to the lockdown, and there is a fair amount of demand coming in for non-premium affordable economy segment in which these two essentially operate. But we'll talk about the fundamentals with Gaurang eventually. First coming to Kunal on the technicals. Kunal, which of the charts look better to you?
But both of them are different. I would say completely related to each other. Now, Lux Industries, is a chart which is more steadier in nature. You look at the stock from the March lows as well, from I think 800 or 850 levels. The stock has gradually moved up higher. We see those typical signs of formations. A higher high, higher low kind of a pattern in terms of prices, and that's very steady. You've not seen any major bouts of volatility coming into this stock, and I think if I'm not wrong, typically the average volumes for the stock is also sub 35 or 40,000 odd on a daily basis. So again, it's not a highly liquid name in that category. But for dollar, I think it's a different chart because I think the last 2 months is where you've seen the major pickup of price action. There has been a good surge of volumes for dollar stock as well. So I think in that regards, that this could be a stock which is more of a high momentum stock. So both of them are completely different than each other. Lux Industries, for one, I think is more of a steadier chart. So if you're looking for something from a longer term view, then I would advise that look out for maybe Lux Industries. I think it's at current levels of 1670, very close towards its 15-day moving average as well. So it's reasonably good level for you to enter, and provided your time frame is longer term. But if you're looking for something on the trading aspect and something which is very quick, or swift on the upside with strict stop losses, then I would advise dollar.
Gaurang, what is your view between these two players? Who's poised to tap into the growing potential in the innerwear and leisurewear market, and who has better fundamentals?
Well, Karunya, we believe that if you are looking at great companies with strong management and earning visibility, then I think you should go with the best player in the pack. Point number one. Point number two, what our understanding is on the fundamental side, that Page Industries has managed to penetrate into not only the entry level but the mid segment as well. That means, in effect, they are gaining more market share. Secondly, yes, there is a lot of consciousness, awareness amongst people as far as personal hygiene is concerned, and that's where I think the market share expansion is likely to happen over a longer period of time. And they have also come out with some interesting new lineup of products in terms of not only innerwear but also leisure wear, etc., comfort wear, etc. And they have got some fantastic products to offer. So I would say that instead of looking at a dollar or any other company, look at Page Industries. Yes, when you look at good, strong companies with sound management, they will come with a premium. But you have to look at the angle in terms of earning visibility and how much of growth will that earning reflect upon your investment into the company. So my view is that forget everything else, look at Page Industries and buy that.
Great, Gaurang. Thanks for that. So one can ignore the higher valuations of Page Industries because it does offer that extra layer of security compared to a Lux or a dollar, and opportunity as well. Let's move forward. Rahul Raichan in Mumbai has written to us. He's looking at the FMCG space quite closely, and of course we have a lot of options there, but he'd like to know in terms of high growth, which would be the most attractive place. So Kunal, on the FMCG charts, where do you see perhaps the quickest alpha triggers?
Very difficult, because I think it's typically a sector which moves in a very low low beta kind of an up move, and very strong, sturdy long-term price uptrends. So difficult to categorize that which could be the best of the stocks. But then when I look at the charts, I think Nestle is one of the stock which of course looks extremely strong. It's a high valued stock, high denomination stock, but nevertheless I think the trends for Nestle are quite strong and quite robust. We've seen the stock doing extremely well. I think a couple of years back, I think if I'm not wrong, when the stock had broken past about the 10,000, 11,000 mark, I think from there on it started on into a new trend for itself altogether. But on the shorter term charts, I think if you're looking at something from a time horizon of 3 months, 6 months approximately, then I would suggest something like a Marico or a Dabur at current levels. I think both these stocks are looking extremely poised for a breakout. These stocks have a tendency of rallying up for short bursts of uptrend and then consolidating for longer duration of time before they change their range, and then they start to move up higher, and then the second move which happens is more gradual and steady for these stocks. So I think for stocks like Marico and Dabur, these are the stocks which are showing that second level of breakout on the upside again. So I think if you're looking at it from a 3 month, 6 month horizon, then these stocks could be it could be something which you can look at. But primarily, I think if you're looking for FMCG stocks, I would suggest that you'll have to have a basket of opportunities over here. Don't look at just one or two names in this pack, because when the FMCG pack moves overall, there are a lot of stocks which tend to perform in a very similar kind of a manner. So I would suggest multiple options over here, especially for the FMCG pack.
Okay, thanks for that, Kunal. Gaurang, how about you? Can one concentrate on one or two players in FMCG, or should you pick up the basket?
Well, Varun, you're spoiled for choice, honestly speaking, in this sector. And even during the worst time of lockdown, these companies, especially for the first and the second quarter, first quarter more so because that's the time when we had the severest of lockdown scenario in India. And even then they delivered great set of numbers. Then you had the unlocking, second quarter was better. Our sense is that third quarter, being a curtain raiser from 8th of Jan, with TCS announcing its numbers, would be even better for FMCG pack. So you are spoiled for choice. We are positive on Tata Consumer, Marico, Dabur, Godrej Consumer Products Limited, HUL, ITC, Imami. But if I have to narrow the choice down and give you two options, then my sense is that Tata Consumer Products and Godrej Consumer would be the preferred choice. So you can pick up from either of these two, or you can invest 50-50 into both.
Moving on to our next email query, Amrita Mandik writes to us. She wants to invest in the hotel space and wants our experts to suggest their preferred pick between Chalet, EIH, IHCL or Lemon Tree. Kunal, any of these hotel stocks charts that you find interesting?
Well, yes, but I would suggest another fifth stock in that same category. I would suggest look at something like Indian Hotels. I think it's a much more stronger stock. The stock was at 160 or 165, if I'm not wrong, when in 2019, when the stock was consolidating, it went through a corrective phase, more than half from those levels, and now it's come back to a 125, 130. So it's been a strong and a sturdy recovery for Indian Hotels. The history for the stock as well on long-term charts is very, very interesting. It's been very positive for the stock, and I would sense that somehow these hotel stocks, and specifically for Indian hotels, I think it's ending its long-range consolidation. Now, whenever you see these stocks going through multi-year consolidations and breakout, the breakouts are not short-term breakouts. These breakouts result into multi-year upside for these names. So I would suggest that look out for from the hotel packs specifically, look out for something like Indian Hotels. It's come back to a 50-day moving average as well, approximately at 120, 125 zone. So I think in terms of a short term or in terms of a buying rate as well, I think it's come back to an attractive zone. So I would recommend Indian Hotels from this space.
Okay, Gaurang, how about you? Now that travel is picking up, hospitality and hotel sector is also slowly crawling back to normalcy. Of course, there's still some more distance to cover for that. But which company do you see is poised to benefit from this revival?
So Karunya, we are extremely underweight on hospitality sector, especially when you have concerns with the new strain. and you have countries going into absolute lockdown like in UK and Germany. And our advice is on the fundamental side that at least for the near to mid-term, unless you get clarity, don't go and venture out into sectors which are extremely vulnerable to any kind of further negative news flows as with respect to COVID-19 or the new strains or the new avatar of COVID-19, etc. Because hospitality sector and multiplexes along with aviation would be the first casualties in case if there is some kind of a negative news flow. And honestly, Karunya, we don't have any coverage in hospitality or at a particular hotel stock, hotel stocks. My advice would be that look at IT and over there mid-cap IT, because that's where I think you will see great strength in terms of earnings which are likely to unfold. And if I have to name a few investment ideas in the mid-cap IT universe, then L&T Infotech, L&T Technologies, Mindtree, Coforge. These are some 4 or 5 names from a long-term point of view that you should look at.
Fair enough, Gaurang. Why stick around waiting for a tide to turn when you can simply hop on one that's already playing out quite extensively? These mid-cap and small-cap IT stocks have done so well. Gaurang just mentioned some quality names, so do your own research. Let's move forward then. Next query, pharma sector. Ipca Labs, Puneet Malhotra, he's already bought 200 shares at around 2,120. So it's a recent purchase, might be slightly in or out of the money. He'd like to know things from a one-year standpoint. So Kunal, obviously I'm sure your technical insights might be quite avid over here for an Ipca. What do you think? Warrants entry, or can one hold off for a bit?
I think it's an excellent chart, and it's. I'm surprised that the viewer is looking at it from just a 1 year perspective. The stock has a long history of giving some fabulous returns from 2004 2005 when the stock actually bottomed out. From there on itself, I think it's been to a fabulous upside. So and the stock seems to have a tendency of going into strong return phases on a longer term time duration. So if you look at it in a contracted time zone of 6 months, 1 year, maybe 1.5 years, then the returns could be very, very average. But if you try and expand the time horizon and look at it with a with a scope of 5 years plus, then you would see the real returns being developed into these kind of names. So I think the first thing is that you've bought into a good stock, but then the horizon which you have bought into, I think, is something which you need to tweak a bit. I would suggest that you hold it from a longer term duration, because the stock seems to have a tendency of going to long bursts, periods of long uptrend. And I think if that's the case, then possibility of even a 2,500, 2,700 for Ipca Labs over the next maybe couple of years could not be ruled out.
Okay, and Gaurang, how about you? What's your take on an Ipca Labs? Are there any better pharma companies of a similar size, or do you think Ipca's got a lot to offer?
So honestly, Varun, with this COVID-19, you have sectors which are going to be terrible performers, and there are going to be sectors which are going to be, outstanding performers. And pharma particularly happens to be one of them. We are extremely positive. We are almost 12 plus companies under our coverage as far as pharmaceutical sector is concerned, and Ipca happens to be one of them. Hold on to it and buy on dips would be my advice from a long-term point of
view. Okay, great. Quite clear-cut advice from both our experts as far as Ipca is concerned. It's a thumbs up. On that note, thank you to both of you for joining in this morning. As always, great to get perspective on things. With that, we're done with the queries part of our show. We would now like to bring to your attention a small cap stock. And we were just talking about these mid cap and small cap IT stocks. Gaurang was. Intellect Design is on the ET Now radar currently. It's done fairly well. The product mix has evolved towards higher margin products. So EBITDA margins, gross margins have really shot up. The deal environment seems to be really picking up. The company's pursuing a lot of new contracts aggressively. They recently spoke to ET Now just this morning, in fact, and said that they're seeing a lot of traction within the BFSI vertical, which is where they are entirely focused, and they provide a lot of solutions to some of the leading banking and insurance clients. So keep your eyes out on this stock. It's already been a 6x this year from March till now, 50 rupees, quotes at 30 rupees, but there are definitely some strong reasons why. And here's a slice of this morning's conversation with the management of Intellect Design, Mr. Arun Jain, who spoke a lot about what's currently happening. Let's listen in.
There are few tailwinds which are there in the world market. First is around cloud adoption, then AI. These are the disruptions happening in the technology space. And these two disruptions, cloud and AI and machine learning, are the major disruption, which is driving a very high digital adoption. And COVID has accelerated that journey. So whatever we are supposed to do in our business plans in 22 is being preponed by 18 months because of the COVID. So it's a positive for the IT companies overall landscape, because now it's not about digital outside the bank for the customer, it's digital inside the bank for their own employees, because employees are also not able to participate and come to the office itself. So it's an end-to-end digital, which is creating a great opportunity. And with the two major disruption of the technology space is a further accelerating the higher investment in this space, and which is being leveraged by large IT companies, as well as for intellect, which is having a product assets which we can multiply, because it's a license business. License business has a ability for generating much bigger recurring revenues. As of now, our recurring revenues are close to 450 crores. Our annual recurring revenue from subscription revenue and AMC revenue, and this recurring revenue comes at a margin of 80%. So that's quite a good mix when we try to look at intellect journey in last quarter results.
Welcome back. You're still watching Buy Now, Sell Now. It's time to reveal our quiz answer. We asked you which capital goods company reported the highest margins last quarter. That's Q2 of FY21. The options were ABB, BHEL, Cummins India and KEC International. The correct answer to this question is Cummins India. Let me pull up the name of the champions as well. First is Mridul Malviya, and second, we don't have the real name, but we have the Twitter handle. It's called the Fero Equity. These are the two winners, two candidates who've got it right as far as today's quiz is concerned. Thank you so much for all of you for participating.
All right, coming back to financials, as a prequel to the results, which will be out shortly in the coming 2 weeks, we'll have the Nifty lenders all reporting their Q3 numbers. We, of course, already have the updates, right? So we have from HDFC, IndusInd, Federal Bank, HDFC Limited, Bajaj Finance. We've also had some updates from the non-financial lenders. But first, let's just look at HDFC. The bank is outgrowing advances and deposits. So both growing in double-digit teens. So advances above 16-17%, deposits at 19%. That's outpacing IndusInd and Federal by a fair margin. Federal's growing at around 12%. Their credit's growing at 6%. IndusInd is barely growing credit YOY, but deposits have shown a significant uptick. So whether it be liabilities or advances, HDFC is leading, but Federal and IndusInd both are making up serious ground when it comes to the build-up of their deposit franchise. And that's also because credit growth is slowing right now. It's actually helping that. HDFC Limited has shown a healthy 26% growth in individual loan disbursements. So that's a very good sign. Bajaj Finance, with their deposit book, witnessing a very healthy 17.6% growth. So again, liability side, the focus seems to be there in an environment where credit growth is not exactly at its peak and credit demand is not at its peak. It's good to see that all the lenders are building up strong deposit franchises. Then coming to Godrej Consumer, we have some stable demand across their various categories. So we've now looked at the FMCG side of things. Marico's India business is clocking good double-digit volume growth. JSPL coming to metals, highest ever production and sales. Management is very optimistic, and then Titan with the jewelry segment back in growth phase. So if these Q3 updates are anything to go by, we may just be in for a very solid Q3 earnings season, but only time will tell. Let's not speculate. As we wind down the show today, we have one last interesting conversation for you. The equity markets have rallied tremendously. While investing is important, however, it is equally important to have a proper exit strategy in place, especially when the market rallies. Getting out is way more important than when to get in. To help you formulate the way out on the Money Show, we caught up with Sunil Javeri, who is the founder of MyMrBond.in, a B2B platform for mutual fund distributors. Let's listen in.
What people do not realize is this is just they are recouping their losses of March. They have not got into hugely positive territory at all. We had given an exit call in July 2017 when we went into a conservative asset class. By March, actually, if you were invested in, say, large cap fund, the value of 1 crore in March was 85 lakhs. In a mid cap, it was almost 60 lakhs. In a small cap, it was 45 lakhs. So from there on, you are just recouping all the losses. So even currently, if you see from 1st of July to now, large cap Nifty 50 has delivered 11.3%. And all of us know that that is also because of the polarized 10 or 15 stocks which have delivered returns. Mid caps have barely broken even and gone into positive territory, delivering about 3.5 or 4% returns. And small cap, by the way, is still in the negative to the tune of almost 1.5%. So please put things in perspective over the last 3 years and you will realize that this raging bull rally is nothing but recouping of losses for many of those buy and hold investors.
Okay, that's an interesting take, actually. Sunil still believes that whatever we've been seeing till now is actually just sort of the markets trying to recoup the losses that we've seen, since March. In fact, if you look at it from a more larger perspective, I think there's still some more room, or at least Sunil believes that there's still some more room for a rally. So Sunil, at this point of time, especially for long-term, investors, most of our viewers invest in equity mutual funds. They do so via SIPs or lump sums. Most of the time they're investing, with a goal that's more long-term in mind. Do you think they should absolutely stay put right now?
No, I'm not saying that at all. I'm saying that, people are just getting carried away with the current rally. Markets are overstretched in terms of valuations, be it on price to earning, price to book, or market cap to GDP also. At historical highs, we've never seen this before and on a sustainable basis for the last 4-5 months. Yes, you should have an exit strategy. When the markets are expensive, all you need to do is move from expensive or a aggressive asset class like equity and get into something like dynamic asset allocation funds, which would be, say, 30 or 40% in equity at the current juncture because markets are expensive. What I was trying to tell you when I said that, markets are only recouping losses, we are back to that March, scenario again between Jan to March. Something similar is happening now where the second lockdowns are happening. The global markets are extremely expensive also.
With that, we're going to wrap it up right here on the show. Thank you so much for tuning in.